Hello, it's Jack here at System Trader, and in this very short video, I'm going to present you a simple portfolio which was introduced by J.L. Collins, Simple Path to Wealth. I will make the screen bigger so that you can see better what I'm showing you here. Basically, the portfolio is very simple, and it has only two parts. The first part is stocks, and we have here 75% of American stocks. In that case, it's S&P 500 IVV ETF, but you can also have the ETF which is covering the whole stock market in United States. It will not make a big difference, but just for the sake of backtesting, I used S&P 500 because it allows me to go back even to over 100 years in history to test it. And another part in portfolio is for bonds, for fixed income, and here I put 10 years bonds, and how that simple portfolio was performing over the years. So let's see the results. And I have results going back to 1920. So we have over 100 years of history here. And as we can see, the annual return was around 9.6%. But in the meantime, we would have to go through the maximum drawdown which was about 72%, which is very severe. It's very difficult to go through such a deep and serious drawdown. And also, if we take on the years, we have 78 winning years, which had a positive return, and we have 24 losing years, which more or less tells us that around 75% of the time the years are ending with a positive return. If you would like to see the details in months, you can check it in my software month by month. And also what is quite interesting is to look on the returns for a given period. And if you would take a period of 5 years, and that period would be rolling, then we had a few cases when even after 5 years, that portfolio would generate a negative return, which is important to appreciate it, because if we have a very short horizon with our investment, then we can be really disappointed that after 5 years our portfolio has a negative return. So definitely this is a long-term investment. And also, if you go to some other details, you can see that obviously over the years the equity line is going up, which is not surprising because the stock market over decades is going up. But the biggest problem, if I could say something critical about that portfolio, is that it's very American-centric. So it holds only American stocks. And I think that it wouldn't do a big harm, and actually it would do the opposite. It would be very advantageous to put here the global stocks. Even if the returns in the short term will be lower than what we could have, for example, in the last decade, having only American stocks, but definitely it's worth to at least think about, because basically it's not about maximizing the return, but about maximizing our let's say safety feeling, that we are not struggled with the problem that American stock market is going into the bad decade and the rest of the world is maybe performing better. So then we just hold the whole world in our portfolio in terms of stocks, and I think that this is better no matter if you are located in United States or not. But this is just my idea, and I think that it's good to play a bit with other versions of that portfolio, for example, using my software. So I think that it can be very advantageous to see how that portfolio would behave if we would put, instead of American stocks, global stocks. That's it from my side. Thank you very much for your attention and have a good day. Bye-bye.